Welcome back to the deep dive. We spend a lot of time talking about the cutting edge of finance. AI trading, market disruptions, all of that.
The really exciting stuff.
The exciting stuff, exactly. But today, we're doing something different. We're taking a very deliberate step back.
All the way back.
All the way back to the absolute bedrock of financial health. Because, before you can even think about high-level investing or complex strategies, you have to lock down your stability.
That's so true. Our mission today is really foundational. We're looking at stability, whether it's for you personally or for a business. And it all really hinges on two basic things.
Okay.
First, just rigorous cash flow discipline. And second, a really deep, almost institutional understanding of how credit actually works, how you're measured.
Or stripping it all down to the essentials.
The absolute essentials.
And our source material for this deep dive, it provides this incredibly rigorous, almost academic way of looking at it. This is the framework that, banks, major lenders, professional planners, this is what they use to assess risk.
Right. It's not just, spend less than you earn. It's the cold logic that determines whether you're building your financial house on solid concrete or, well...
On quicksand.
On quicksand, yeah.
So this deep dive is really focused on the mechanics of it all. We're talking foundational budgeting, this is interesting, the sometimes counterintuitive way expenses are classified.
Mm-hmm.
A full analysis of lending through what's called the 5 C's framework, and even how a business should handle temporary cash surpluses.
Our whole mission here is to give you, the listener, a shortcut to understanding that institutional logic that really dictates financial success long before you ever think about putting a dollar into a speculative investment.
And we've pulled out some genuinely fascinating takeaways. We're going to reveal the surprising classification of savings that, on a technical level, trips so many people up.
It's a big one.
A huge one. Then we'll break down the 5 dimensions that lenders use to judge you. And it's so much more than just your income. And we'll explore why even a successful business with a pile of cash is seen as inefficient if that cash is just sitting idle.
And the overarching principle, and this is pulled directly from our core sources,
Right.
is that you have to master cash flow and credit before you can attempt anything sophisticated. It all has to come first.
It has to stabilize everything else.
Exactly. It all flows from discipline and just clear categorization.
Okay, let's just jump right in then. Let's unpack this with the absolute basics, because this is the checkpoint where our sources anchor all financial reality.
I know where you're going.
Classifying expenses correctly. It sounds simple, but this is arguably where everything can go wrong, right? It's where our personal feelings and emotions start to skew what's actually necessary.
Absolutely.
Right.
The foundational step to getting any kind of stability is to be ruthless, just ruthless in separating your spending into 2 buckets. That's it.
Needs and wants.
Needs and wants. Or, to use the technical terms, non-discretionary expenses, your needs, and discretionary expenses, which are your wants.
And it's not a judgment call, is it? It's not about how important something feels to your quality of life.
Not at all. It's a cold, hard assessment of what you need for basic existence, for pure function.
Okay, so let's start with the hard costs, the non-discretionary stuff, the needs. These are the things that form that absolute baseline of any budget.
By definition, a non-discretionary expense is something required for basic living and functioning. The key thing about them is that they are, they're difficult or just plain impossible to eliminate.
You have to pay them.
You must pay them. It doesn't matter what lifestyle you want. These are the costs of just being. They are the financial floor. If you fall below this, survival itself is at risk.
And the source materials is really specific about how limited this category is. It's not a broad definition. We're talking about, shelter, food.
Right. Shelter, essential food, essential transportation, and some basic protection. That's pretty much it.
So let's tick through the examples, because the precision matters here.
It really does. So number 1, rent or mortgage payments. Shelter is non-negotiable.
Of course.
Number 2, and this is a big one, basic groceries. And the source is so clear on this distinction.
What's the distinction?
It specifically excludes dining out. It excludes, high-cost organic or gourmet items. It excludes prepared convenience foods. It is laser-focused on raw sustenance, what you need to cook at home to not starve.
That is such a critical point of separation, isn't it? So let's say I spend, $500 a month on groceries to cook basic meals. That's a need.
Non-discretionary, yes.
But if I spend that same $500 eating out at restaurants, only the part that's equivalent to the raw food cost is the need.
Exactly. The rest of it, the service, the convenience, the ambiance, the tip, that's all discretionary. It's a want, even though the underlying purpose, eating, is a necessity.
So it's the way you satisfy the need that determines the category.
Perfectly put. The means defines the category. Okay, next up, utilities. We're talking heating, water, electricity, and maybe a basic internet connection if it's required for you to hold your job.
The essentials for safety and work.
Right. Then, transportation required for work. And again, the scope is so narrow, it's the bus pass. It's the gas for a basic commute in a reliable car.
Not the payment on a luxury SUV.
Exactly. If your car payment is, say, $800 a month, but you could reliably get to work for $300 a month, that $500 difference, that surplus cost shifts right over into the discretionary column.
And the last one from the sources.
Insurance premiums. But again, the framework is strict. It's only basic coverage, the stuff you need to protect against a truly catastrophic, wealth-destroying event.
So minimum liability on your car, basic homeowner's insurance.
Yep. These are the costs that if you don't pay them, they immediately threaten your ability to function or even earn an income.
Okay. Now let's contrast that very rigid list with the other side of the ledger.
Oh.
The soft costs, the discretionary expenses, the wants.
These are everything else. They're optional. They're tied completely to your lifestyle choices. Or they're things that just enhance your life beyond the bare minimum requirements.
And in a budget, they serve a really critical function. They're like the main lever you can pull, right?
We're the only lever, really. They are the budget's shock absorbers. When cash flow gets tight, you lose a client, your hours get cut. This is the entire category you look at to make immediate cuts.
You don't have a choice to not pay your mortgage, but you absolutely have a choice to cancel your streaming services.
Absolutely. If you lose your job, the mortgage still needs to be paid. But that premium gym membership, gone. That vacation you were planning, postponed. Those subscriptions, canceled.
So examples would be things like cable, streaming, any kind of entertainment spending, vacations, luxury goods.
All of it. These are choices. They are not mandatory for sustaining your current function.
Okay, so this brings us to the really fascinating counterintuitive point. The source material flags as a frequent conceptual trap.
Ah, yes.
The big one.
The classification of savings. Right. So from this very rigorous institutional budgeting perspective, which is, remember, focused only on current cash flow sustainability, voluntary savings and investments are classified as discretionary.
I have to push back on that. I mean, that feels completely wrong. It goes against every piece of financial advice you ever hear. Saving money, putting it in an emergency fund, contributing to retirement. That's the most important thing you can do for your future. How can that be a want?
And that's the trap. This is the crucial mental shift the framework forces you to make. The classification is about necessity for basic current living. It is not about long-term financial importance.
Okay, unpack that for me.
Ask yourself this question. If you stop putting $500 into your retirement account this month, will you immediately be thrown out of your apartment?
Well,
Will you starve? Will you lose your job because your car gets repossessed?
no, of course not.
Right. So while stopping your savings is without a doubt a terrible decision for your future self, it doesn't compromise your immediate functional stability today.
So the logic is just brutally focused on the here and now, the immediate balance sheet. Paying the electric bill is a necessity now. Choosing to set aside some of your income for future use it's a powerful choice, but it's still technically an optional financial choice in this moment.
Precisely. Think about it. If your income suddenly drops, you have the immediate option to pause that voluntary contribution. You can defer your future wealth building to make sure your current non-discretionary needs are met.
Because it's adjustable.
It's adjustable, and it's not mandatory for sustaining basic life right now, so it has to be categorized alongside Netflix and going out for dinner.
That distinction is so important for real financial planning then. Because if your baseline, your non-discretionary needs, already eats up, say, 90% of your income,
You're in trouble.
you have no real stability. Even if you're diligently saving that last 10%, the first time you need a car repair or have a medical bill, you're toast. You'll have to compromise on your core necessities.
That's the whole point. You have to know your true baseline. So the big takeaway for you, the listener, is this. Needs versus wants is a technical assessment of necessity, not a moral judgment on importance. Once you master that, you're ready to look at the other side of the coin, how the outside world judges your stability.
Okay, so let's make that shift. We've gone from the micro, your personal cash management, to the macro level. to the institutional risk analysis. Let's talk about the standard framework that lenders use to figure out if you're going to pay them back.
We're talking about the 5 C's of creditworthiness.
Yeah.
This is the universal language of lending. It's applied across the board from a simple credit card application to a massive commercial loan.
And it provides a really comprehensive scorecard.
Right.
Right, it's not just one number.
Not at all. It's 5 distinct, crucial dimensions.
So let's get into each one. Let's start with the first C, which is character. And to me, this feels like the most human component of the 5.
It is. Character is all about your willingness to repay. It's the qualitative assessment. It's about your reliability, your trustworthiness, your financial responsibility.
So how does a lender, a bank, quantify something as vague as character?
They look for evidence. They look at several inputs. First and foremost, your entire credit history. That report is just a long, meticulous record of you keeping or breaking past promises.
Every late payment, every default, it's all there.
It's all there. They also look at your financial habits, things you can see on that report, like your credit utilization ratios or you're constantly maxed out. And they even gauge your demonstrated financial knowledge during the application process.
So a lender is really betting on the person.
Mm-hmm.
The data is just proof of past behavior, which they hope projects future character.
That's it exactly. And the source material highlights a really key connection here, a kind of exam nuance as it's put. When they're looking at character, lenders often weigh a combination of things. Okay, so get this. A combination of a really high net worth, which we'll cover under capital, and poor financial familiarity can actually be a red flag for character.
Wait, that seems totally backward. If someone has millions of dollars, why would it matter if they're not, a financial expert?
Because net worth is just a snapshot, static number. Financial familiarity and habits. Those are dynamic. They show behavior over time.
Yeah.
So if a borrower has a high net worth, but they're constantly paying bills late, they're overutilizing their credit, they make financially irrational decisions, the lender sees poor character. They see a fundamental lack of discipline or respect for financial agreements.
So they're afraid that the wealth alone won't prevent a default that comes from just bad behavior.
Or even just carelessness. Exactly. On the flip side, you could have a borrower with a very modest net worth, but their payment history is impeccable, and they can clearly articulate their financial situation. That person demonstrates high character, and that significantly improves their profile.
Character drives the expectation of repayment.
It's the foundation of trust.
Okay, let's move on to the second C, capacity. This one feels more like the raw numbers, the engine strength.
It is. Capacity is all about the borrower's present ability to repay from income. It's a hard analysis of cash flow strength. Lenders are looking at your income levels, the stability of that income, and most importantly, your debt service ratios.
DTI.
Debt to income.
DTI. We need to spend a minute on this because DTI is the absolute bedrock of capacity analysis.
So what are they actually calculating? What's the formula?
They're calculating the percentage of your your pre-tax monthly income that is already being eaten up by your existing debt payments.
And they usually look at 2 different numbers, right?
They do. There's the front-end ratio, which is just your housing expenses, so your principal, interest, taxes, and insurance, or PITI.
And the back-end ratio.
A back-end ratio is your PITI plus all your other minimum required monthly debt payments. So car loans, student loans, the minimum payments on all your credit cards, everything.
And is there a magic number? The threshold that lenders look for? There is, though it can vary a bit. For a standard mortgage, for example, the guidelines often say that your back-end DTI, all your debt payments combined, should not be more than, say, 36% to 43% of your gross monthly income.
So if you're already at 50% DTI, even with a high salary, your capacity to take on new debt is seen as dangerously low.
It's seen as maxed out. You're under cash flow stress. So if character is your intention to pay, capacity is your current logistical ability to pay. They check your pay stubs, they verify your job is stable, and then they run the numbers to see if you can actually handle one more monthly payment.
If the capacity is weak, it doesn't matter how good your character is. The lender knows that one little disruption to your income could cause an immediate default.
That's the risk.
Okay, now for the really important distinction that I think trips a lot of people up. The difference between capacity and the third C, capital.
Yes. This is a crucial one. Capital is focused on your balance sheet strength. It's your financial cushion, your reserve pool.
Your net worth.
It's your net worth. The total sum of your assets minus your total liabilities. So if capacity is measuring your income flow,
capital is measuring your accumulated stock of resources.
Exactly.
Let's use that analogy we talked about before. I think it clarifies it so well. Capacity is the size and the health of the engine that's running the car month to month.
Right, how much power it's generating.
And capital is the size of the reserve fuel tank. If the engine stalls, I lose my job, a big medical bill hits. How much stored resource do I have to keep making the loan payments until I can get the engine started again?
That analogy is perfect. It completely captures the lender's perspective on risk. High capital gives you a buffer. It tells the lender that even if you have a temporary disruption to your capacity, you have the reserve savings investments you can liquidate to keep servicing the debt without defaulting.
It lowers the risk of default.
Significantly. Capital is why a very wealthy person who has, say, volatile income from a business might still be a great credit risk. Their capacity might fluctuate, but their capital is immense.
Okay, on to C number 4, collateral. This is the physical security part of the equation.
Right. Collateral refers to a specific asset that you pledge to secure the loan. And the C is critical because it only applies to secured credit.
Like a mortgage or a car loan.
Exactly. Or a secured business loan. If there's no asset pledged, this C is just not applicable.
So how does a lender figure out the value of that collateral and how much risk does it actually take off their plate?
The main metric they use is the loan-to-value ratio, or LTV.
LTV.
LTV is simply the loan amount divided by the appraised value of the asset. And lenders will always require the LTV to be well below 100%. For a mortgage, it's often 80% or less.
And that gap, that 20%, is their buffer.
It's their cushion. That buffer is absolutely critical because if you default, the lender has to go through the whole process of seizing the asset, maintaining it, and then selling it. And that process costs a lot of money, legal fees, administrative costs.
So if I buy a house for $500,000 and I borrow $400,000, that's an 80% LTV. That extra $100,000 is what protects the lender if the market goes down or they have to foreclose.
Exactly right. The presence of that cushion and their legal right to that asset just fundamentally changes the risk profile of the loan. It transforms it from a bet just on you, your character and capacity, into a dual bet on you and the value of that physical asset.
Which is a much safer bet for them.
A much safer bet.
Okay, that brings us to the final C, number 5, conditions. This is where the outside world comes into play.
Conditions covers all the external macro factors that influence the loan's risk. It's about context. And it includes two main things. First is the purpose of the loan.
What do you mean by that?
Well, is the money being used for something productive, like buying a piece of equipment that's going to generate more revenue for your business, or buying a primary home to live in,
Versus
using it for something high risk and non-essential, like pure speculation in a volatile market? A lender is going to feel very differently about those two scenarios.
Okay, and the second part of conditions.
The second part is the broader economic and regulatory environment. I mean, if the entire national economy is heading into a deep recession, even a borrower with strong Cs is suddenly a much higher risk.
Because their job, their capacity is less secure.
Right. Or if interest rates are spiking, that affects the cost of debt for everyone. If the government passes a new regulation that squeezes the profits of the borrower's industry, that's all part of conditions.
So even if my first 4 Cs are rock solid, a lender might still say no if they perceive a huge external risk. Like, they wouldn't want to lend to a business in a rapidly collapsing industry.
That's the power of conditions. It's the lens they use to look at threats that are completely beyond the borrower's control. It acknowledges that none of us operates in a financial vacuum.
And when you put all 5 together,
You get a truly full spectrum, holistic assessment of the risk.
with the 5 Cs now firmly understood, let's zoom in on probably the most common and maybe the most financially dangerous type of consumer debt out there: credit cards. Our source material makes this very clear distinction between secured and unsecured debt, and credit cards are the absolute textbook example of unsecured credit.
This is such a critical section because the mechanics of unsecured debt directly explain why it's so expensive and why it can be so destructive if it's not managed carefully. And it all starts with what's absent.
A missing C.
The missing C. The crucial element of collateral is gone.
So from the lender's perspective, what are the key negative features when there's no collateral on the line?
The lender has no safety net. It's as simple as that. There is no pledged asset. If you default on your credit card balance, the lender can't just show up and repossess something specific like they would with a house or a car.
I can't just take your TV.
They can't just take your TV. And what's more, they have no automatic access to your bank accounts. They can't just dip in and take the money they're owed. They are forced to rely entirely on the legal system to try and collect that debt after the fact.
Which means the lender is giving you money based entirely on your personal promise to repay.
100%. That promise is backed only by their assessment of two of the other C's. Your character, will you pay? And your capacity, can you pay? The moment you default, their only option is to start what is usually an expensive and very time-consuming legal process.
To get a judgment against you.
Right. And even if they get a judgment, that might only allow them to then attempt to garnish your wages or place a lien on your property. And those processes are often capped by law or just wildly inefficient.
The shift in risk from a mortgage to a credit card is just.
Yeah.
It's enormous. The absence of that asset protection is the single biggest reason for the loan's costs.
It's everything.
So let's connect the dots here. Why are credit card interest rates so dramatically higher than almost any secured loan?
It's pure risk compensation. Because the risk of default and the cost of recovery are exponentially higher for the lender, they have to price that risk into the interest rate you pay.
The high APR is basically covering a few different things for them.
It is. That higher APR, that 18, 20, 25%, it serves three main functions. First, it compensates the lender for the expected percentage of users who are going to default entirely and they'll never see that money again.
So the people who pay are covering the losses from the people who don't.
In a way, yes. Second, it covers the very high administrative and legal costs that come with trying to collect on bad debt. And third, it provides the required profit margin for a product that isn't backed by a tangible, easily sellable asset.
It's like financial hazard pay. They're taking a bigger risk, so they demand a bigger reward.
And if we connect it back to the 5 C's, without collateral, the lender has to lean so much more heavily on your character and your capacity being flawless. But even if they are, the structural risk of this type of loan still demands that premium price.
We should also probably talk about the mechanics of the debt itself, because that's part of the risk too, isn't it? The fact that it's revolving debt.
Oh, that's a huge part of it. Unsecured credit is typically revolving, which means you can use it, pay it down a bit, and then use it again all the way up to your limit.
Which is completely different from an installment loan, like a car loan, where the balance only ever goes down until it hits zero.
Exactly. That revolving structure, when you combine it with very low minimum payment requirements, allows a borrower who has weak capacity to mismanage that debt for years and years. They can just perpetually carry that high interest balance.
That low minimum payment is so financially deceptive. It makes the debt feel manageable in the short term, but it locks you into a cycle of interest payments that just destroys your financial stability over time.
It's the ultimate trap for someone with weak capacity. If you only ever pay the minimum, the vast majority of that payment is often just going to cover the interest that accrued that month. It barely touches the principal balance.
So you're running on a treadmill.
You're running on a treadmill. The borrower stays heavily leveraged. They're paying this huge interest rate on unsecured debt, which in turn immediately lowers their capacity. It worsens their DTI, which then makes it even harder for them to qualify for the good kind of debt, the necessary lower rate secured loans like a mortgage.
It's a vicious cycle.
Mm-hmm.
And it all starts with the inherent risk of an unsecured product.
And the ease of its revolving nature.
It's just fascinating how the absence of 1C collateral just escalates the cost and the danger of borrowing so dramatically. And the source material really emphasizes that this simple logic, it shows up in a lot of tricky scenarios because people forget the defining feature of a credit card isn't the interest rate itself.
The interest rate is just a symptom.
It's a symptom of the lack of a pledged asset.
That's the root cause of it all.
Okay, so we've laid down the law on personal financial discipline and the institutional logic of credit. Let's pivot now to the commercial side, because this kind of discipline is just as vital for a big company as it is for an individual.
It really is.
And this brings us to the topic of managing temporary cash surpluses. It's all built around this core idea that in a commercial setting, idle cash is inefficient cash.
This is a real hallmark of sophisticated financial management. For a business, capital has to be working. It has to be productive. Cash that's just sitting in a basic checking account earning zero or next to zero interest. That represents a direct, quantifiable opportunity cost.
Not to mention inflation.
Exactly. With inflation eating away at its value every single day, that cash is literally losing purchasing power. It's failing to contribute even a modest return to the business. It's a lazy asset.
So how does the framework we're looking at define surplus funds in this business context?
Surplus funds are defined as temporary excess cash. The key words there are temporary and excess. These are funds that are not currently needed for immediate operations or for any scheduled liabilities. It's a short-term overage, a float.
And what are the common ways a business ends up with this kind of temporary flow?
It's almost always a function of timing differences. For example, a consulting firm might get a huge lump sum payment upfront for a 6-month project.
But their expenses, like salaries and rent, are paid out monthly.
Right, so for the first few months, the bulk of that cash is temporarily surplus. Another classic cause is business seasonality. Think of a toy manufacturer. They rake in massive revenues in October and November
For the holiday season.
for the holiday season, but they might not need that cash to pay vendors or buy new inventory until, say, March or April of the next year.
So this cash has a defined purpose. It's just not needed right now.
Exactly, and this is so crucial. Because it has that near-term purpose, the management of this cash has to be treated completely differently from how a company manages its long-term strategic investments.
Like its employee pension fund or a 10-year capital expansion fund.
Totally different worlds. The source material is adamant on this point. The goal of investing these short-term surplus funds is not growth. It's not capital appreciation, and it's absolutely not speculation.
So if it's not about growth, what is it about?
The mandate is fundamentally conservative. It has to be, because this cash is required to be available to meet critical operational needs on a specific timeline. So the priority shifts completely away from high returns and towards security and accessibility.
Okay, let's detail the 3 strict primary objectives for investing these funds, and they have to be in order of priority.
Yes, the hierarchy is everything. The first objective, the absolute top of the pyramid, is to preserve capital.
And what does that mean in practice? What does that mandate really force you to do?
It means safety is non-negotiable. The business cannot, under any circumstances, tolerate any meaningful risk of losing the principal amount. If they have $1 million surplus that they need in 3 months to buy raw materials, then in 3 months, $1 million must be there.
No exceptions.
No exceptions. So that immediately rules out a whole universe of assets. No stocks, no equity funds, no long-term bonds, which could easily go down in value over a short period. This cash needs preservation, not a home run.
Okay, priority number 1, don't lose the money. What's objective number 2?
Maintain liquidity.
So it has to be easy to get back.
Exactly. The funds have to remain accessible with minimum delay and minimum cost. Since the timing of when that cash is needed is pretty fixed, the investment you put it in can't have long lockup periods or impose big penalties for withdrawing it.
High liquidity means you can turn it back into cash for operations the minute that invoice comes due.
A moment you need it,
And that brings us to the third and final objective.
which is to earn a modest return.
And this one is very much in third place.
It's a distant third. This objective is secondary. It exists purely to be a good steward of the company's cash. That modest return is really just meant to offset the damage from inflation and to compensate for the opportunity cost of letting the funds sit completely idle. You're looking for a safe yield, just enough to justify the effort, but never, ever at the cost of objectives 1 and 2.
Safety and liquidity always come first.
Always.
So to meet these really strict conservative criteria, capital preservation, high liquidity, short-term maturity, what specific investment tools are considered appropriate for this job?
The list is very short and very focused. It's all about ultra-safe, short-duration debt instruments.
Okay, let's start with treasury bills, T-bills.
T-bills are a perfect fit. They are short-term, zero-coupon debt instruments that are backed by the full faith and credit of the U.S. government. So in terms of credit default risk, they are practically risk-free. That nails objective 1.
And for liquidity.
They mature very quickly, a few weeks to a year, and they trade in a massive, deep secondary market. That means you can sell them instantly if you need the cash back earlier than planned, so that's objective 2. And they provide a modest, risk-adjusted yield.
Objective 3. Checks all the boxes.
What's next on the list? Money market instruments.
Right. Money market instruments, which are often held in a money market fund, are basically a pool of highly secure, very short-term debt from high-quality issuers.
Oh, not just the government. Not just the government. It could be certificates of deposit from major banks or commercial paper from blue-chip corporations. But these funds are designed for stability. They operate under very strict rules about asset quality and duration. They offer stable capital preservation, and they're priced to maintain a consistent net asset value, usually $1 a share, which makes them highly liquid and very low risk.
And the final option.
The simplest of all, short-term deposits.
So just a high-yield savings account or a short-term CD.
Exactly. Simple, short-term fixed deposits or savings accounts, which are guaranteed by federal insurance, like the FDIC, up to the legal limits. The return is often the lowest of the three options, but for cash that's needed very, very quickly, say in less than a month, the capital preservation and liquidity are the absolute highest.
The clarity here from the source material is just. It's
That-
absolute. Surplus funds are temporary, they must stay accessible, and they demand a completely separate, conservative cash management philosophy that has nothing to do with the firm's long-term strategy for growth.
And that distinction, using your short-term funds for preservation and your long-term funds for growth, that is a key insight that separates basic financial awareness from true financial stewardship. And that's true whether you're running a Fortune 500 company or just managing your own household's emergency savings fund. The principle is identical.
This has been such a practical and, I think, a crucial deep dive. We've really gone into the fundamentals of financial stability. It might be less exciting than picking the next hot stock, but it is infinitely more important for long-term financial health.
Let's quickly recap the major takeaways we've pulled from the source material.
We started with the absolute necessity of correctly classifying your expenses,
Yep.
and we really hammered home that counterintuitive lesson, that voluntary savings, as important as they are for your future, have to be categorized as discretionary from a pure operational cash flow standpoint.
Right. Getting that clarity is the only way to set a realistic, non-negotiable financial baseline for yourself.
Then, we did a comprehensive breakdown of how lenders conduct that full-spectrum risk review using the 5C's character: capacity, capital, collateral, and conditions. And we learned that the behavioral side, your character, is just as critical as the hard data of your income and your net worth.
Then we dissected unsecured credit. We learned that the simple absence of collateral is the single reason that interest rates are so high. It's essentially hazard pay for the lender because their risk of losing money is just so much greater.
And finally, we just covered the specialized, highly conservative mandate for managing temporary business surplus cash. We reinforced that the objectives there are strictly about preserving the principal and maintaining liquidity, not about speculating for growth.
And if we tie all of that together using the institutional logic from our sources, it's clear. Mastering your cash flow, being precise about your expenses, and really understanding how credit works. These are the foundational pillars that determine your financial stability long before any aggressive investing can even be considered.
Everything really does flow from discipline and clear categorization.
It does.
Which brings us to our final provocative thought for you to take with you. If the core logic of lending dictates that character, which is fundamentally driven by your reliable financial behavior and your depth of financial familiarity, if that is weighed so heavily alongside cold, hard data, like your income,
Your capacity.
your capacity, then what are the most fundamental shifts in your daily or monthly personal behavior that, even before you earn a single dollar more, would immediately and tangibly increase your perceived financial stability in the eyes of an institutional lender?
Think about the habits you keep, the promises you make to your creditors, big and small, the understanding you demonstrate of your own finances. At the end of the day, that's the true asset a lender is really betting on.
Something for you to mull over as you work on your own financial foundation. Thank you for taking this deep dive with us. We'll see you next time.